Hello, everyone. So welcome to video 3 of chapter 3. We're going to go into kind of a list of items today that would be included in your employee benefits. But first, we have to identify what are employee benefits and how do we decide what is something that needs to be included in income and what is something that doesn't. Well, we're going to start with sort of the legal definition or the basic concept of an employee benefit. Employee benefits shall be included in the computing of income of the taxpayer for a taxation year as income from an office or employment, the value of board lodging, other benefits of any kind, whether received or enjoyed by the taxpayer or by a person who does not deal with arm's length of the taxpayer in the year in respect of, in the course of by virtue of the taxpayer's office or employment. So that is a very legal way of saying a taxpayer has to include in income the value of anything received by virtue of their work. If I get something for work or because I work at a place, then it has to be included in income. If a workplace is giving out, maybe they're giving out phones. So all of their employees gets a phone. Okay, well, I've gotten something. That is employment income. It's by virtue of my job. But what if the company's giving out phones to anyone who walks by on the street between the hours of, 2 o'clock and 5 o'clock on a specific day? Okay, well, I didn't get, if I picked up that phone, I didn't get that phone by virtue of my employment. I picked up that phone because I was a member of the public who was receiving them. So if your employer gives the phones to its employees, it has to be included in income because you got it by virtue of your employment. If you got something out on the street as a sample or a test, that's not employment income because it's not related to your job. So a taxpayer has to report the value of anything received either by their work or because they work there. Now, if they gave it to your spouse or a child or a family member, not directly to you, it's still part of your employment. So the taxpayer is the individual employee. The benefit is any economic advantage where the employee is the primary beneficiary. So economic advantage means it's not always you received something worth a monetary amount. Sometimes your work saved you money. This is when we go into, especially when we calculate automobile benefits. If your work provides you a vehicle, your benefit is you didn't have to purchase your own vehicle. So we calculate that benefit kind of based on how much money did you save. So economic advantage is always, did they improve your financial outcome either by providing you income or saving you money? The value is most often the fair market value. Fair market value is what is the value that would have been negotiated between two persons in an open market. Received or enjoyed refers to when benefit becomes taxable. We mentioned in a previous video that employment income is on a cash-based accrual system, a cash-based system. So it depends on when you received it. When did you get the paycheck? When did you get the phone that you received? And it will be included in whichever tax year it occurred in. It has to be by virtue of the taxpayer's office or employment, refers to the capacity test, except any benefit. So there are a number of benefits that are explicitly removed from being included in income. Do we get into it on? I think there's a slide soon where we talk about the exceptions, but one of the biggest exceptions is healthcare plans. Your work can pay for a healthcare plan for its employees. That is a benefit you receive. You're not paying the premiums, but you don't have to report it on income because there is a specific exclusion for it. So how do I know if something is an employee benefit? There's a 5-step analysis. Is there a benefit? Some sort of economic advantage? Has the benefit been received because of an individual's employee? Is the beneficiary the employee or the employer? So if your employer, if you get a job at a workspace, an office, and they provide you a laptop, well, that laptop goes in my bag and comes home with me. But the primary beneficiary is my workspace. I use the laptop to access the network, perform my job. They didn't give me a laptop for my enjoyment. They gave me a laptop because it's necessary to do my work. So the primary beneficiary is the employer. But if I've worked there for a year and they said, "Hey, we really like what you're doing. Here's a laptop for your personal for your enjoyment." Now I'm the primary beneficiary. There's a work computer I still work at, and now this laptop's for my personal use. So they have to look at who's benefiting from a specific transaction. If it's going to be included in income, we need to have a value to be included. So if I got something from work and the value of the benefit's $0, then there's nothing to include, right? So there needs to be a benefit, and that benefit needs to have a monetary value associated with it. And then we look, is the benefit specifically excluded? So reason for non-salary benefits. If non-salary benefits are going to be included in income, then why not just give me the money and I'll pay for it? One is the income tax considerations. Not all benefits are taxable. Like I said, health plans are a great non-salary benefit that I can enjoy the benefits of without including an income. It's also employee motivation and employee retention. They have found that when it comes to enjoying your workspace, it's not always about the dollars and cents. Money is a primary source of motivation for going to work, but having alternate benefits, things that provide enjoyment and additional perks, it can help motivate employees and help keep them on. People will stay on at a workspace even if it pays them slightly less money, if there's additional benefits that they can enjoy. So interpretation of Tax Act legislation is we look at court decisions, CRA interpretation. So the CRA will list out, here's the five-step analysis. There's some specific exclusions, but maybe I got something unusual from my work. I might not think it's a taxable benefit. Maybe the CRA says it does. So we might look at, well, what did the court say? So legislative guidance, the Income Tax Act, Section 6 talks about various inclusions. Amounts received as an allowance for personal or living expenses. Basically, if you ever get money from your job, it's going to be included in income. Specific amounts can have certain expenses deducted from it, but if you're getting an allowance, it's almost always added to income. Certain directors' fees, we are going to have a specific focus on automobile standby charge and operating expense benefit. I'm going to have a video specifically on calculating those benefits. Reimbursements and award and wage loss replacement plans. These are certain exclusions. The standby charge and the operating expense benefit are going to be some of the major items we will focus on in a later video. Before I go too far into legislative guidance, I want to go through exercise 3-2. So we're going to look at a couple cases and we're going to decide, is this a taxable benefit? The first case is, in each of the following cases, use the five-step analysis to indicate whether there's a taxable benefit. We're not going to worry about sales tax at this time. The first case is, an employee received the latest smartphone from their employer. The phone retails for $1,500. The employer advised the employee that the phone is to be used primarily for employment purposes, but personal use is allowed. Any personal charges require the employee to reimburse the employer. So let's go down this line. Here we are. So is there a benefit? There is a benefit because we've received a phone, and that phone is worth $1,500. We have a phone, it has a value. Did I get it through employment? Yeah, through employment. Yes. My employer is the one who provided the phone to me. So I now have this device in my hand. Are phones a specific, is there a specific exclusion for phones? No. But who's the beneficiary of the phone? Yes, I have a phone. Yes, it was provided by work, but my workplace says this is for work purposes. Now you can use it for your personal purposes, personal reasons, but if you incur any additional charges, you're going to have to pay us back. So there's no benefit to me. This $1,500 was the price for the workplace to have a phone, to have access to me so I can have certain capabilities. Any additional amounts beyond this 1,500 is going to be paid back. So even if I used it for personal purposes, there's no dollar value to me because I'm going to have to pay them back for any personal use of the phone. So the primary beneficiary is the company. So going down our options, we have one red. We need these all to be green to say there's a taxable benefit. So this red, we are not the beneficiary, the company is. So this is probably non-taxable. In case two, an employer's office contains dozens of paintings. The employer wants to replace the art and decides to sell them to interested employees. One employee pays $500 for a painting valued at $2,500. Is there a benefit or is there an object that we're discussing? Yes, we are discussing paintings. The benefit came to me, I bought a painting. Was the benefit received through employment? Yes, they only offered the art to their employees. If this was an open auction and I could attend and bid on art I wanted, then this would be a no because it was open to the public. But since only employees could take part in this, these discounted art prices, it was through employment. Now, the primary beneficiary of this transaction is me because the value of the painting was 2,500. I was able to purchase it for $500. So the company had $2,500 of value that they're giving up for $500. They are purposely taking a discount to support or entice me to buy the painting from them. So I'm getting a heavy discount, so I am the beneficiary. The company is giving up more than I am giving up to buy it. There's no specific exclusion for paintings, but what is the value? Although the value of the painting's 2,500, I am paying $500 to buy it. So I'm giving up 500, I'm getting 2,500 in return. So I'm increasing my economic position by $2,000. I'm this value of this benefit is the difference. So we always kind of look at the difference between what was received compared to what was given up. So I would say, yes, this is taxable. The $2,000, the difference after what I was paid, is the taxable amount. I paid $500. I got an additional $2,000 of value. Case three, one of an employee's friends works for the same employer and attends the employee's birthday party. The friend gives a check of $200 as a gift. We have a benefit, $200. This is a gift. There's no specific exclusion for gifts. There are some specific rules around gifts, and I will get to it later. But for now, there's no exclusion. Is the benefit for the employee or the company? I'm the employee. It's my birthday party. The $200 came to me to use as I will. Was it received through employment? Although I work with this friend, I don't think the friend came to my birthday party as a representative of the company. They came to my birthday party because we're friends. We work together, but we're still friends. So they came to my birthday party as a friend, gave me $200. So that gift was not related to my employment. So that gift's non-taxable. Now, if that friend worked in the HR department, they came to the birthday party and they said, "Oh, hey, here's my gift." The boss also sent $200 as a birthday gift for you, then that would be associated with employment because they came as a representative of the company, as a member of HR, saying, "Here's a gift from the company of $200." But we are not told that. We just said this is a work friend who came to our birthday party, so it's not associated with the workspace. The last case, an employee wants to purchase a home but has been turned down by 3 banks. The employer does business with one of the banks and calls them, agreeing to personally guarantee the mortgage as long as the employee is working for the employer. The employee receives the mortgage as a result of the employer's intervention. We have a benefit. We got our mortgage. The only reason we got that mortgage is because our boss, our employer, vouched on our behalf. The beneficiary is me, and there's no exclusion for loans. The hiccup in this case is right now there's no dollar amount. Even though, yes, a mortgage has come to me, I've gotten cash, I've used it to buy a house, I'm going to be paying that mortgage back. So right now, there's no benefit to include. So I would say, okay, it's taxable, but the taxable amount is $0. The thing is, the mortgage is guaranteed, personally guaranteed by the employer. So if for some reason I fail to pay a mortgage payment, or if I'm default on the loan, my employer might have to pay the difference. When that happens, when the employer puts up the money, I will have a taxable inclusion in my income for however much was paid off in my name. So let's say I got a $200,000 loan. I've been paying it off for as long as I'm an employee of the company. And when there's about $80,000 left, I default on the loan. And my boss has to pitch in the $80. They pay off the rest of the loan because they guaranteed it. So now that benefit of 80,000 will have to be included in the income because it's $80,000 I didn't have to pay. It was 80,000 paid on my behalf. So that is the case in that sense. So right now, as long as we're making our mortgage payments, there's not really anything to include. Okay, going through some more legislative guidance, this is going to talk about a handful of provisions. Starting at exclusions, the employer contributions to a registered pension plan is not taxable right now. That money will be held in the plan and will become taxable when I withdraw in retirement, but I don't include it in income now. Group sickness or accident insurance plans, often called, group healthcare plans, also private healthcare plans, um, provided benefits received under plan are taxable. This is a bigger subject that I'll talk a bit more later, but generally, if they're paying for health insurance or health plans that's available to all the employees, then it's not included in my income. If they're specifically paying plan premiums for me, but they don't provide it to the rest of the employees, well, that's a specific benefit, so I might have to include it. But many workplaces offer some sort of health plan to their staff. So those premiums that they pay for us don't have to be included in income. This also provides for certain counseling services, mental health, reemployment, and benefits resulting from reduced tuition to children of teachers at private schools. So, for example, Fanshawe is a college and it is a private school because you have to pay the tuition to go. So Fanshawe staff might have a break on tuition, or perhaps their children get a break on tuition. That is a benefit, but because there's a specific exclusion for it, it doesn't have to be reported in income. So Tax Act Section 6 is like the default fair market value that applies to most benefits other than excluded benefits. Group term life and benefits related to automobiles are excluded in Tax Act Section 6 due to the value. The value is not fair market value. So this section of the Tax Act is trying to identify what is the fair market value that's going to be included. I mentioned before that standby charge in automobiles and operating expenses, you don't immediately include the market value of the car. There's a calculation. So those are I would say those are excluded from inclusions because there is a different part of the Tax Act that includes the formula that calculates pretty much the value equivalent for the use. And we will talk about that in more detail later. So there are certain provisions being the reasonable standby charge. It includes the standby calculation, payments by employer to employee, group term life insurance, special worksite or remote location, inclusion of sales tax. So when your work pays sales tax, they will have ITCs, they get the money back. But when valuing a benefit, if I paid for it myself, I would have had to pay the sales tax. So the funny thing about sales tax is despite the fact that your employer is going to get that money back, it's still going to be included in your income because you would have had to have paid it had you done it yourself. Interest on employee debt and forgiveness of debt, and we will discuss many of these items later. So, at 20 minutes, I think I just want to go through this handful of slides to just list out some employee benefits. And when we come back in the next video, we will begin our discussion on vehicle benefits and standby charges. So here we go. The following slides provide explanation of some of the employee benefits, often some of the most common ones. So one is cell phone and internet. Cell phone provided by the employer to carry out employment duties is based on primary beneficiary concept, no taxable benefit despite incidental personal use. The CRA position is to establish benefit based on personal use. So if I have a personal cell phone that I occasionally use for work, the CRA will say, okay, that's your personal phone. So if your work is paying that bill, that's a taxable benefit. If my work is providing me a phone that they pay for, but it's for work purposes, well, now work's the primary beneficiary, and those payments don't have to be included in income. So many executives, for this reason, will have a personal phone and a work phone so that they don't have to muddle with this gray area. So if CRA ever says, we think that's a personal phone, you say, well, no, 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 no. This is my personal phone. This is my work phone. So all of the costs associated with this phone are deductible in the business and not a part of my income. Internet service, difficult to establish the primary employment related, because if you have unlimited Wi-Fi, how do you quantify that 80% of it was for work over personal when it's unlimited? Like I use it for everything. So CRA's position is to try to establish benefit based on personal use. So if you have Wi-Fi or internet in your home, they generally assume it's for personal use unless you can establish this is work related. Very few people have a second modem for their job. They just have one internet modem in their house. So for that reason, generally we do see internet service, if it's paid for by work, to just be included in income. But cell phones are easy because you can show the two different devices. Many people who work for a company, especially a retail company, will get a discount on merchandise. This benefit is not taxable as long as all employees have access to the discount and the discount price is not below cost. So if I worked at a furniture store and they sold couches, they bought couches for $500, sold it for $1,000. So if they give their work folks a discount of 30%, well, 30% off 1,700. The company's still making money from selling me the couch. I get a discount. The company still makes money, but there's no taxable benefit because the 30% discount's available for everyone. They're not singling me out to get, preferred pricing. However, if they buy the couch for $500 and they sell it to me for $300, now they're just buying me couches. There's no profit motive there. They bought that couch to give me a deal. So I will have to include in my income that price difference between what I paid and what the company paid for the couch. This administrative concession does not extend to services or high ticket items, only because I might not be able to afford a Ferrari in any normal circumstance. So if I work for a dealership and I get a significant discount, even though the dealership might have made only a little bit of money, I had no means of affording it without their intervention. So this administrative concession is not looking at luxury items, it's more looking at day-to-day retail purchases. The biggest of which might be furniture. Mostly it might be discounts on clothing. If I work at McDonald's, I have discounts on food, and that's fine. You don't have to report that benefit. If employer provides allowance for employees' children, the allowance is included in employees' income for education related, pays tuition for course either directly related to recipient's employment or general business of employer, not a taxable benefit, pays tuition for personal interest, a taxable benefit. So what this is saying is, if your work is paying tuition or course fees, it's not taxable in your hands if the course is for your job. So when I worked in public accounting, every year I had to go to courses to update, tax updates for new tax rules. Maybe there's audit guidance we had to be updated on. Because those courses directly relate to our job, our work would pay for it, and it's a business expense. We need to know that stuff to perform our function. But if my work paid for a course for my personal interest, let's say I'm into writing novels and I take a creative writing course, my creative writing isn't translating to my accounting spreadsheets. So though that course isn't related to my job, so therefore the tuition paid by my corporation is a taxable benefit. My workplace paid something for me. If they provide allowance for employees' children, the children don't work at the company, so that allowance is also included in income. Employer provided childcare. It's not a taxable benefit if it's provided at the employer's place of business. It's only for employees of that business, so it's not available to the general public. And the services are managed by the employer and available to all employees. If I'm an executive and my work pays for a nanny to watch my children, that's going to be a taxable benefit. But if the workspace has a child care room that anyone who works there can drop their kids off and their children are safe and minded on site, then that's not a taxable benefit because it was available to everyone. All conditions must be met, otherwise the benefit is taxable. But if it is taxable and included in income, I can consider that amount to have been paid for childcare expenses. But that's something that's covered later, chapter 9. So don't worry about that now. Really just focus on its childcare is non-taxable as long as it's provided by work and it's available to all employees. Your work can give gifts. It might be customary. Your workplace gives you a Christmas gift around the holidays. So all gifts and awards would be taxable employment income. However, the CRA kind of gives an allowance, and the allowance is up to $500. Now, if your work gives you cash, it's always included in employment income. They gave you money, that's included. It comes if they gave you gifts, non-cash awards. So maybe um, everyone got I very old. I wanted to say Walkmans. Let's say everyone got Bluetooth headphones. So your workspace said, "Hey, here's new headphones for everyone who works here." That's not a taxable gift as long as it's under $500. If they give multiple gifts, those gifts can add up to $500. The only taxable portion is whatever goes over that $500 amount. If there's immaterial gifts, a lot of companies would call this swag, t-shirts, hats, maybe a backpack, USBs that have the logo of the company. You might get this swag that's not taxable. They're too immaterial. I'm not going to work at a place because they got me a blue USB. They might have that swag for advertising purposes. They want you to wear the t-shirt with the logo because it gets their name out. So those immaterial amounts we're not going to worry about. We want those non-cash gifts and awards. You can have another allowance of up to $500 if the gift is specific to sort of a long time service or anniversary award. So you've been with the company 5 years, here's a watch. Okay, so only up to $500 is non-taxable, but you will include in income any value over 500. Anything related to performance. So if it's ever called a bonus, you might get this for like sales commissions. Hey, you made your quota. Here's an extra, however much, here's an extra trip. Here's a vacation. That's taxable because it wasn't a gift as like for holidays. It was a gift related to your job, your performance. Therefore, it is consideration. It's compensation for your work. So that is employment income. Non-cash gifts. So if they give you a gift card for Amazon, that is considered near cash, so you would include it. But it can be totaled into that $500 gift allowance if it's provided for a special occasion. So my birthday, maybe I'm getting married, maybe I'm having a kid and it's, um, kind of a baby shower type thing, then that's the first criteria. It's preloaded with money and can only be used to purchase goods from a single or group of retailers, meaning it's not like a Visa gift card. If it's a Visa gift card, I can spend it anywhere. But if it's something I can only spend at one business or one group of businesses, and terms of conditions state it cannot be converted to cash, then it can be included in this $500 allowance. So if I have a $200 Amazon gift card they gave me for my birthday, that doesn't need to be taxable. But if they gave me a $200 Visa gift card, that is taxable. The key detail being one is easily convertible to cash or cash usage, whereas one is specific to the business. We're at 30 minutes. I'm just going to try and finish up these last couple slides. Um, Log maintained to keep track of information. So when they give these gifts, in order for that gift card to be considered a gift and not cash, they have to keep track of who they gave the card to and why. Why was it? Just to ensure that it was for a holiday or an event like their birthday, a special occasion. If conditions are not met, then the value of gift card is always included in income. We don't include it in that $500 exemption. Loyalty and other points. Technically considered taxable if earned while carrying out employment duties. However, CRA does not require inclusion. So you might have a work credit card. That work credit card that you spend for work purposes will accrue points. And maybe those points can be used for, if they're reward miles, I can take a trip. Maybe I can exchange them for a computer, electronics. It doesn't have to be included in income. Um, as long as the points are not converted to cash. Also, you can't have it embedded in your like incentive package. So it says your salary is going to be 80,000, but you get to use any of the credit card points you accrue. Now they've included it as part of your incentive package, so therefore it's employment income. So it has to be incidental to its usage. It's just a little bonus from using that work credit card that you occasionally get. And I've already stated that premiums for healthcare, provincial healthcare premiums paid by employer, taxable benefit, but private healthcare service plans, non-taxable benefit. So private healthcare being those private, dental plans or pharmaceutical plans that you might have. So the provincial healthcare premiums is taxable, private healthcare, non-taxable. I'm going to stop there. When we come back, I might do a quick review of employee benefits, but I'm going to go through a couple exercises to say, is this an employee benefit? Is it not? After which we will get into automobile benefits and trying to figure out how much are we getting, what's the value we get from using a company car. Thank you for your time. See you in the next video.